Good afternoon. This is Tom Alexander. This is the video addendum to the weekend report that I send out every week. If you are not receiving that report and you would like to receive it, please send me a note to tom@alexandertrading.com and I will put you on the list. It's free and you'll be notified when I do these weekly updates. Also, if you find value in the video, please like it. Please subscribe to the channel. I'm happy to answer any questions, comments, etc. So, and happy 4th of July. Today is, again, it's Sunday, July 2nd. The 4th is on Tuesday. Volume next week is going to likely be light. That doesn't mean we won't have a lot of movement, but it's typically one of the lower volume weeks of the year. Now, according to The Marketeer, which is an excellent website, themarketeer.com, the next 2 weeks are the two most bullish weeks of the year. So we shall see. You never know how stuff like that is going to turn out. We'll see. Okay, let's take a look at the charts. We're going to start with the weekly view, which I like to do. And what I'm going to do, I'm going to start with the Russell because I let off with it in the report. And the Russell is, you can make a strong case that we're in a bull market in the SPX, the Dow, and the Index. Certainly, the Russell has been doing nothing but chopping around since the low, the double bottom last June, and then again in October. And once again, it's near the midpoint of this range. It closed last week at an important area to the upside, but even above this 1911 area that we're bumping up against now, there's another area above it. And this is what has been confusing a lot of traders, a lot of analysts in particular, and confusing analysts, the macro analysts, as well as the people who use technical analysis. And this is where I would encourage you to just follow the structure of the indices. And that's been difficult to do because typically the structure of the indices, the ups and downs, the pivot lows on a weekly basis, a daily basis, tend to be very highly correlated among the four primary U.S. trading indices. That has not been the case this year, particularly with the Russell being a constant outlier. It's been difficult for me to really press the long side of the market when I see the Russell not really participating or confirming yet a bull market. Now, maybe that's going to happen, but it's going to happen if we're going to go much higher in the other three indices, because the divergence between the Russell and, say, the Index continues to widen and is at historic levels at the moment. But if you just look at this in a vacuum, let's just say this was the only stock index, the Russell, then what you would be saying is, okay, a break above 1911 is really important. A break above 1816 is really important on an intermediate term basis. End of story. So that's I think how we have to take this market. We have to look at each index, find the key reference areas, and then pay attention to what happens when the market is near there. And we're near an upper key reference area in the Russell. It's right here. It's very clear. 1911 to the upside, 1816 to the downside. Now let's take a look at the NDX. In the NDX, actually now, there is, from an auction market perspective, which is the perspective that I use in terms of analysis and in terms of trading, there is no resistance above recent highs. This level right here at about 15,303, that was the high 2 weeks ago, until the all-time highs, which is only about 10% higher from this rally high. Now, to the downside, last week's low is going to be important in the NDX. All right, let's take a look at the SPX. And similarly, in the SPX, we have traded above that high that we made in the Index. So this is a little bit of a minor divergence. And we're only about, let's see, we're even closer now as of, because of Friday's frenetic ramp higher. We're about 8% to a new all-time high in the SPX. And to the downside, the immediate downside level will be last week's low. And then if we look at the Dow, and the Dow is bumped up against this area. This is a critical area, this 34,566, 34,884 area. And once again, above that level, you have decreasing, there's really no resistance until you get to an all-time high, which is only about a little less than 7% from the high a couple of weeks ago. Now let's take a look. Let's go down in time frame and take a look at the daily indices and see if there's any fine tuning we can do. So let's start with the Russell. And here you can see the Russell bumping up against that important level. We've made several highs in this area. We could not get through there. We bumped up against there Friday, could not get through there. So once again, this is a very, very clear, these are very, very clear, obvious levels. You have the recent highs here around 1899, 1907, and then to the downside, 1828, 1817. And then we'll switch over to the NDX. And in the NDX, it's the recent high back here. This was made on the 16th, and then the low, last week's low, which is around 14,685. Then below there, here's another level. And then above there, here's your all-time high. Okay, let's look at the SPX. And the SPX is now, you're increasingly in guessing territory. The next level, obvious level, well, 4,500, just because it's a round number and their option volume will be clustered around strikes of 25. And of course, you have 4,500 is the next, really the next big option strike. So that will be a level to keep an eye on. But above there, then you're looking somewhere around 4,600. And of course, to the downside, the immediate level is 4328. And the Dow. And you can see it's very clear here, the importance of this level. We bumped up against this level. We can't get through it. And once again, to the downside, it's very clear, 33,592. Now let's take a look at the internals. Now, if you are new, I use very, very simple things to analyze the market. I don't use indicators, oscillators, magic numbers. I use simply price action through the lens of auction market principles. Now, the exception to that is I use NYSE internal data. It is part of the auction. It is sort of the weeds of the auction. And what you see on my screen here, the red line is a 10-day moving average of NYSE advancing issues. The green is a 5-day moving average of NYSE advancing issues. And of course, the blue is closing NYSE net breadth. And you can see on my chart, it's very clear we have divergences of varying degrees that have formed. We have another divergence in the 10-day, the 5-day. Breadth has been positive now 5 consecutive days. So even in a bull trend, the current rally is getting a little toasty. So if we were to spike up early next week, tomorrow, Monday, now, again, Monday is, we start trading again tonight. Then you have the 4th holiday, and then you'll have the rest of the week be low volume. That doesn't mean we can't ramp higher or lower. But something has to give here. This is diverging dramatically. You're going to, and this is consistent with the position of the Russell. The Russell is obviously more highly correlated than any of the other 3 indices with NYSE breadth because it's 2,000 stocks. But you typically, when you have these divergences of this magnitude that have been lingering for this long, it's a heads up. Now, you cannot rote trade this, but it's certainly a heads up. Now, I'm going to show you another look a shorter term look that is very effective for trading intraday and trades of 2-3 days basis. And this is the SPX. This is obviously cash market hours. This is breadth below it. Now, the price breadth relationship has a very, very consistent pattern to it that will change depending on a given rally, but a given bull leg rally will have sort of a personality to it. And you can see this one certainly has followed that. If you've been following these updates for the past few weeks, you can go back and you can see the discussions up to this point, but it's been very consistent. Now, we reached a momentum peak on Friday, and then towards the end of the day, the rally sort of petered out. Breadth came in a little bit, but you're in an upper extreme from where you typically get some sort of retracement. And then as long as we're in a bull trend, if we get down in here again in breadth, then you're looking for a low. Okay. Now, at some point, what will happen? There'll be a failure. What you'll see is this. You'll have, let's just take a hypothetical. Let's say the market goes down here, somewhere in here, and then breadth gets down in here, and then you have this rally attempt. Breadth will rally, and then this fails, and this pivot is taken out. Let's just hypothetically say this was a pivot low. Then that's an initial signal that the price breadth relationship is flipped, and we are in at least a short-term bearish trend to the downside, something that is sideways to down for 2 or 3 days. And that's as far as you can extrapolate this out, but it does provide a very good guide. Now, you can see it's very clear we've been making higher highs and higher lows in a very consistent pattern now, really going back several weeks. Low, and then you have the extreme down here, then you have an extreme, and you typically what happens is that the retracements in price are accompanied by a contraction in breadth to a downside extreme, and the downside extreme in breadth is more severe than the decline in price. And that's certainly what we've been seeing since the 24th. So this is something we'll be keeping a very close eye on next week. I'll be updating this for members on a daily basis. If you're interested in a membership, go to www.lxentertraining.com and the information is there. I hope you guys have a wonderful 4th of July. I'll see you next week.